Hey everyone, it's Kyan again. So, the oil price, it keeps going up because of this big war in Iran, okay? Now, recession fears, they're back, and it's all over the news headlines, as I'm sure you're aware. But yet, the stock markets keep climbing to record highs. Now, if you've been watching this and thinking to yourself, wait, how does this make any sense? Well, then trust me, this video is for you. Because when you finish watching, you're going to understand exactly why the markets are rising despite the oil fears. You'll know what professional investors are actually watching more than the oil price. And once this is revealed, you'll know precisely what data needs to change before you ever need to worry about a recession. So if you're invested in the markets, you want clarity instead of confusion, stay with me, because this is the piece of the puzzle that most investors never get taught. Now, from the outside, I can imagine how this must look. Okay, you open up the news, you see the oil prices are all over the headlines again. Inflationary fears are the topic of discussion. Analysts on Bloomberg, I know you're probably hearing them talking about the oil price is going to slow economic growth, a market crash is imminent, 20% of the world's oil comes through the Strait of Hormuz in the Middle East. It's a vital artery for energy markets. But then somewhere in the middle of all of this noise, the S&P 500 literally just hit record all-time highs. And you're probably thinking, how? How does the market ignore all of this? The rational mind starts thinking, well, maybe the markets are broken. Or maybe there's actually a version of the story that I'm not being told. And the truth is, there is. Now, what I'm about to share with you is exactly what I've personally been using for years. And it's exactly the same information that I've shared with other investors who have been part of my investment communities. So here's what most people never get taught and they can never fully grasp. The stock market, guys, is not a news ticker, okay? It's not pricing in what's happening today. It's pricing in what's expected to happen to corporate earnings in the future. That's it. That's the whole game. Stocks rise when investors expect earnings to grow, and stocks will fall when investors are expecting earnings to contract. Everything else, oil prices, news headlines, geopolitics, it's just noise. It's secondary. Unless it's going to materially change the earnings outlook for the companies within, for an example, the S&P 500, the market is just going to ignore it. Now, before we get into why the markets are still rising, okay, you need to understand what professional investors are actually watching, because it's not the oil price and it's not the news. It's the macro data that predicts economic growth and therefore earnings growth. Because a strong economy equals strong corporate profits. A weak economy means a slowing corporate profits outlook, okay? If you can track the macro data that predicts the economy, you have everything you need to know about the direction of the stock markets. So here's how professional investors think about this. Earnings don't just appear out of thin air. They're a direct output of economic growth. So when the economy is growing, revenues are growing. And when revenues are growing, profits are growing. And when profits are growing, stock prices are rising. Okay, so the question investors are asking themselves every single month is not what's happening in the news headlines. The question always is, what does the macro data tell us about where the economy is heading next? Because that's what's driving earnings and that's what's driving the stock prices. So here are why stocks keep rising despite the oil fears. It's because the macro data has not broken down yet. Business surveys, especially the manufacturing and the PMI reports that come out once a month, these two reports are like absolute gold to investors. They predict the stock market returns with an 85% certainty. And I've actually done a full video on my YouTube on this. Because if you can hear from business executives in the biggest corporations in the United States or any economy about their earnings expectations, remember, these business owners are on the front line. They're seeing orders coming into their business every single day. They are the first ones to see if the consumer is not spending as much money, if they're expecting their earnings to decline or rise. So when the business surveys come out and they're telling investors that our earnings outlook are getting better, so earnings growth is increasing, okay, the market is going to listen. And at this moment in time, business surveys are still signaling an expansion in revenue growth and earnings growth. And this is why the stock markets are ripping to record highs. Then we have consumer confidence, okay? Consumer spending accounts for around 70% of economic outlook, but the data is still holding. And the reason why the data is still holding is because the inflation expectations, and this is the key when it comes to consumers, because inflation expectations are still anchored around 2%. Even though oil prices are high, if consumers really believe that oil prices will come down at some point, they're going to keep spending. And the surveys for consumers are telling the markets that their inflation expectations haven't become de-anchored away from 2%. All right. And this is why the business surveys are still pointing towards expansion. Okay. So everything else right now that most people are focused on, they're not seeing the bigger picture. And it's all down to one thing, the AI earnings wave. We just had earnings released about a few weeks ago, and all the AI companies are blowing the numbers out the water, okay? And this is what's driving the stock markets. Momentum investors are experiencing some of the strongest returns in decades in the AI sector, where they're buying up semiconductors. If you look at the hyperscalers of the Magnificent Seven, they are investing heavily in AI, and they're expecting their earnings to really start to grow in the coming years, okay? And this is what the markets are paying attention to. Because yes, while the recession fears might dominate the headline, it's corporate earnings from the biggest technology companies that are still expanding at a pace that is overriding all of these macro concerns about the oil price. Okay? And that's why investors are looking past it, past the geopolitics, past the headline, past the interest rate fears. It's because the earnings data is so strong. And specifically, as I said, the AI sector. And this has given them a fundamental reason to stay in the markets. So this is not irrational behavior. That's the market doing exactly what the market is designed to do. It's pricing in earnings, not headlines. And until the earnings expectations start to deteriorate, and that will come when the business surveys start to get negative, or when the consumer starts to become negative and cut back on spending, and until that starts to really reveal itself in the earnings revisions from the companies themselves, the markets are going to hold up. Investors are still going to keep coming into the markets to buy, because we must remember the markets are forward looking. They are buying stocks now based on the expectations of future earnings growth, okay, over the next 6 to 12 months. So at this moment in time, the macro data hasn't given investors a reason to run. Okay, so what we do need to watch though is if inflation expectations keep rising, okay, and really start to rise above the 2% inflation goal that the central bank has. Because if this happens and consumers start to get fearful that this oil price isn't going to come down, then we have a problem. Because that's when the Federal Reserve will be forced to raise interest rates aggressively to keep those expectations anchored around 2%. And that's the signal that could finally stall the momentum. Okay, but that's not where the data is today. So now that we have a clear understanding that professional investors are playing a complete different game to retail investors, they're not worried about the news headlines. They're focused on the macro data that predicts where the economy is heading, because that tells them where corporate earnings are likely to go into the future. So they're investing based on economic growth and earnings expectations. So from that understanding, you can really start to see where most people go wrong, because they see the news headlines about the oil price, which is designed to grab your attention by making fear be the predominant emotion that these news channels are trying to grab your attention with, okay? And automatically it's going to make you feel uncertain. It's going to make you feel nervous. And then you'll end up doing one of two things. You'll panic sell, okay, whenever there's a fluctuation in price, because so many of the retail markets are reacting to every news headline, okay? Or you end up just freezing when you're not in the markets and you could be investing, and you stay out of the markets because you're so unsure of what's coming next. So you're trying to time every news event and thinking, okay, let me just wait till the news changes, then I'll get back in. But the news is constantly negative most of the time. So many people end up locking in losses and staying out the markets when they should be invested. Now you can see why the macro investors, they're looking past these headlines and they're not paying attention to it, because the macro data tells them stay in. They're in it for the long run. They're playing the bigger long-term game. Okay? And they don't let the noise affect their decisions, because that is what investing is all about. Okay? That's not reacting. It is proactively anticipating the earnings expectations and economic growth. Okay? So every time you're reacting to the news, and then suddenly when the news feels like it's more safe for you to now get back into the markets, the market's already priced in the expectations, and they were just comfortably riding the waves of the news. Okay? And this is why you always feel like you're one step behind. So to cement what we spoke about, to really massage this idea into your mind, so this is the predominant way of you now thinking like a macro investor, we want to watch the data, not the headlines. We want to watch the macro indicators that track economic momentum. So we're looking at the business surveys, we're looking at consumer surveys, okay, to find out how confident the consumer is. What are their expectations about inflation? And we want to watch, most importantly, is the earnings expectations and the earning revisions presented to the market by the companies themselves. Okay? And the most important thing you need to understand, which is the piece of the puzzle which so many people lose out on because they just have not had the education, is the bond market. Interest rate on government bonds, which is what is used to price in the value of the earnings of companies, is crucial to this puzzle. All right? And this tells you a real story about macro data. So when those data releases start to deteriorate, okay, that's when you adjust. Not before. Not because oil prices have gone up. Not because an analyst made a prediction on the TV. Not because someone else said in a group chat, or you saw in some forum on Reddit that someone thinks the markets are gonna crash. Professional investors are not into hearsay. All right? When the actual leading economic indicators, the macro data turns, I'm talking about the framework here, this is what drives investors, not the news. It's the economy, the real economy. And once you understand how to read it, once you understand the real sequence of data that you look at every single month and you track, this is where you have a rules-based macro framework that tells you what to do and removes all human emotion. Okay? Because if you don't have a macro framework which tells you what to do with clear rules, you are going to be completely emotionally manipulated by the news. Okay? And this is the difference. You just need a macro framework, and it takes away all the guesswork. All right? And once you understand it, you stop getting shaken out by every headline, and you stop second guessing yourself, and you start making decisions from a place and a point of clarity instead of fear. So if you're someone who is tired of reacting to the markets, feeling like you're always one step behind, okay, feeling uncertain whenever you're investing, and you would really like to have a rules-based macro data framework, okay, that allows you to invest with clarity and confidence and gives you clear rules that you can just follow each and every month, that removes the need of being able to be glued to the headlines, but actually looking past the headlines and saying to yourself, well, until the data turns, I'm staying put. I'm going to stay invested. All right? If that's what you want, then I have something so powerful for you that I would love to share with you. I would like to train you on the full framework. All right? How to read the macro data, how to track the earnings expectations, and how to invest with confidence regardless of what the news is saying. And I've put together a full training on exactly this. Okay, so please head over to macromarkets.co.uk for your free training session. Okay, and I really hope that you take the time to learn what I'm going to teach you, because it's going to transform how you view investing, and it's going to make a massive difference to your life. So I'm glad you've watched this video. Thank you so much for taking your time. I've got plenty more videos to come, and hopefully I'll hear from you soon.